Let's begin this first demo of this module with a paradox. The word tokenomics doesn't actually exist. It is a portmanteau of two words, token and economics, and briefly it means crypto economics. Now, there is a narrative that stems out of this that crypto economics is in some way different to mainstream economics, and you will see that certain cryptocurrency enthusiasts fundamentally believe that there is a difference between crypto economics and regular economics. Economists also haven't really contributed to the cryptocurrency narrative and have distanced themselves somewhat because of the hype and speculation and risk and numerous illegal narratives that have circulated about cryptocurrency over the years, and therefore there is a definite lack of mainstream economic support for cryptocurrencies, even though a lot of the ideas that stem into the cryptocurrency landscape actually come from mainstream economics and are actually developed by mainstream economists before being taken over by crypto enthusiasts. To give you a demonstration briefly of what I'm talking about, I'm going to give you a small riddle. Now you can see here there are 5 strands of this particular token that I'm going to identify. It has 27 trillion in supply, so there are 27 trillion units of this cryptocurrency. There is no supply cap, there is one node, there are 25% of the supply is minted in the last 6 months, and 1% of owners have over 30% of the actual holdings. So what cryptocurrency am I talking about? Well, I'm not actually talking about a cryptocurrency. I'm actually talking about the United States dollar. This is the United States dollar, and this is one of the reasons why there is a narrative that the US dollar is inferior as a unit of monetary concern. Let's contrast this with the second one, which has 21 million supply. It is capped. That means there's a finite limit of them. There are approximately 10,000 nodes as of this recording. The supply reduces with a steady and exponential decay. So that means that over time you can plot how much of the new coin is going to be generated. And to be in the top 1% of holders, you merely need 0.3 Bitcoin, which is the one I'm talking about, or $10,000. Okay. So you can see there is a narrative that stipulates that Bitcoin supersedes the United States dollar because of these tokenomics. Okay, because there's only a 21 million supply that's never going to change and not endless supply like the US dollar, because it's capped, because there are approximately 10,000 nodes and not just one, which has a single point of failure. If the Federal Reserve tomorrow decided that they weren't going to issue new dollars anymore, the entire economy, the US economy, would collapse. Whereas if Bitcoin, if one node goes down, or 2 nodes, or 4 nodes, or 6 nodes, or 8 nodes, however many nodes, the network can still function very, very well. The supply reduces with a steadily exponential delay. That means that over time we can plot, or anyone can plot, how much Bitcoin is left to be generated, and the influx into the market can be calculated. With the US dollar, on the other hand, we can't do that. Coronavirus obviously came along in early 2020 and 2021, and the US government was forced to print more money because of that external circumstance. With Bitcoin, that cannot happen. With most cryptocurrencies, that cannot happen, where you can't have a situation where new cryptocurrency can be generated just by circumstances altering. And Bitcoin is more egalitarian, perhaps, than the US dollar. Now, obviously, the US dollar is used by many more people at the moment than Bitcoin. But in order to be in the top 1%, you need 0.3 Bitcoin. Now, this may change over the course of the next 5-10 years or so, but at the moment, the egalitarian narrative sticks to Bitcoin more than it does to the US dollar, because obviously US dollars have been a product of money making and inequality throughout the Western world for a very, very long time. Okay, just like gold before that. I will be talking in this video about market capitalization, which I appreciate is in the next video. Okay. All the market capitalization means is it's the total number of units of a cryptocurrency divided by the total number of capital. So if Bitcoin was worth £1 or $1, then obviously the market cap will be $21 million or pounds. Okay. That's what I'm going to be talking about in this particular video, and I'm going to be showing some demos of what I mean by different types of crypto tokenomics. Now, tokenomics are one of the first things that I look at when I look to evaluate a particular crypto project and work out whether I want to actually risk entering the market. So let's look at Bitcoin and look at its tokenomics. 21 million supply, that's fixed, that's never going to change. We've got a circulating supply, so that's currently in the market of 18,739,900. And we've got the fully diluted valuation. That means if all 21 million tokens were in existence, it would have a valuation of $683 billion, $696,874,000. Okay, but the actual market cap itself is 610 billion. Because of the discrepancy between the circulating supply and the maximum supply. Now notice I'm not looking at the price, I'm not looking at the lows, the highs, etc. All I'm looking at is just the number of tokens and the total amount of capital behind those tokens to work out the market capitalization. Okay, and I'll return to that a little bit later. So what you might say it would be the case if someone were to print a new Bitcoin. Okay, so this actually did happen. Okay, there is a cryptocurrency called Bitcoin Cash, which is merely a fork of the Bitcoin code. And when Bitcoin Cash was created, I'm not going to go into the narrative of what happened there now, but it still has 21 million tokens. Okay, but the price is radically different to Bitcoin's because the amount of capital behind the cryptocurrency is nowhere near as high. We've got a market cap here of 9 billion. Against a market cap of 610 billion. Okay, so fundamentally there's a lot less capital behind Bitcoin Cash than there is behind Bitcoin, and therein lies the capacity for profits. Bitcoin has a higher market cap, but therefore has less or fewer opportunities for profit because it takes so much more effort for the price to double. $610 billion would have to come into this market cap right now for the price to hit $65,000, which is the previous all-time high at the time of recording. Whereas in order to double Bitcoin Cash, all that would be needed is $9 billion. Okay. Now, the likelihood of introducing that type of capital into any particular cryptocurrency is also another art and science of determining what's likely to happen. But I hope you can see that tokenomics can actually help you make trading decisions based on the available units of cryptocurrency and also the amount of capital that supports it. I'm going to go into two diagrams here to demonstrate. So imagine you're buying a book, okay, and it's a rare book, and it's one of only 100 in existence, and therefore you're, willing to pay quite a lot of money in order to get a hold of a copy because it's a collectible. It might be signed, it might be a first edition, it might be several hundred years old, etc. The point is, it's valuable because it's scarce. Now, over time, it's discovered that actually the book is more common than you thought by quite a significant margin, by a factor of 100 in fact, and it's only one of 100,000 in existence. Okay, what does that do to the value of your book? Well, the value of the book plummets, okay, because suddenly it's no longer scarce, it's no longer rare. This is the same with cryptocurrencies. With cryptocurrencies that have fewer tokens, you're likely to see higher prices ultimately than lower prices, and vice versa, as we'll see a little bit later on in this video when I show a demonstration of two very, very different tokens for the purposes of this example. But you basically get the idea. The rarer the token, i.e. the fewer tokens that exist, generally speaking, the higher the price, and vice versa. The more tokens that exist, generally, the lower the price, and the more difficult it is for the price to remain high or low. Same with this, okay, so market capitalization, the more capital that supports a cryptocurrency, the higher the price per unit. What this means is if $10 million was was introduced into cryptocurrency that was only worth $1 million, the price would increase by 10 times. But if $10 million was introduced into Bitcoin, it would hardly move the price at all, because obviously the more capital, the bigger the pot, basically, the less new capital makes a difference. Okay, so say this was a cryptocurrency that only had $5 million behind it, okay, and we're going to pour another 5 million in. Obviously that price would go up by 100%. Okay, this is a cryptocurrency that has $500 million behind it, and we're going to put the same $5 million in. The price would only move 1%. Okay, so effectively, in order to target cryptocurrency investing, the more aggressive you want to be, the lower the market capitalization of each of your cryptocurrencies needs to be. If you really want to be aggressive, you can pick very high risk but also very inexpensive or very low capital cryptocurrency projects with solid fundamentals, where you can make more money more quickly, but the risk is also higher. Okay, so those two elements are essential to understanding tokenomics and essential to understanding why these numbers are important. You're looking at the scarcity or the rarity of the token in combination and against others as well. Okay, and you're also examining the total amount of capital behind it, because the more capital in the pool behind each cryptocurrency and the more number of units it's divided by, the less likely you are to make a profit. Ultimately, you want to own as much of the cryptocurrency market as you possibly can do, and the more units that exist, or the more capital that already is in the cryptocurrency prior to you investing in it, the poorer your results will ultimately be, all other things being the same. Okay, now obviously there are ways in order to circumvent that, trading, etc., leverage, that kind of thing, but we're purely talking about tokenomics here rather than anything else. So let's examine two other cryptocurrencies. Now, obviously, Ethereum, a very popular cryptocurrency, 116,381,000 tokens out of a possible infinite supply. Now, that's a little bit of a point of contention. There's no longer an infinite supply of Ethereum. They do plan, Vitalik Buterin does plan on curtailing this at some point, but at the moment it's as good as infinite. Okay, versus Ethereum Classic, which has 128 million out of a 210 million circulating supply, which is capped. Okay, so even though this cryptocurrency is capped, it's still, the price difference is extreme. Okay, and obviously Ethereum Classic is a fork of Ethereum once again, so it did theoretically start from 0 and work its way up to 45, but the discrepancy is still there, partly because of the hack and the way that the Ethereum Classic was created. You can look into that if you wish. It's outside the scope of this particular video, or alternatively because the tokenomics are very, very different, and obviously there are a lot of fundamental differences between Ethereum and Ethereum Classic which also lead to this price discrepancy. But one of the biggest things is likely to be the circulating supply, almost double for Ethereum Classic as opposed to Ethereum itself. Now let's look at two otherwise very similar tokens. This is XRP, or Ripple, which is currently going through a little bit of a fundamental issue with the SEC, okay, and Crypto.com. Now, the interesting thing about these tokens is that Crypto.com originally had the exact same amount of cryptocurrency units as Ripple, i.e. 100 billion, okay. Then a few months ago, they decided, Crypto.com that is, decided to lower the amount to 30 billion. Okay, so effectively cut the supply by 70%. Now, this sometimes does happen, and it's always worth looking into. Now, the effect of that was actually to increase the price, albeit temporarily, because then we did have a return or a correction in the overall market, which hindered the explosion of price. But effectively, the market cap completely then was able to absorb 70% of the tokens that were going to be used on the market. Okay, and there was a nice jump in the price that theoretically someone who'd been trading according to tokenomics could have taken advantage of if they chose to. Okay, the point being that this market cap was no longer divided over 100 billion units. It was only divided over 30 billion units. Okay, Now with XRP, we have a circulating supply of 46 billion tokens against a total supply of 100 billion, but all these already exist, which is why looking at the market capitalization and the fully diluted market cap is important. Okay, on this particular page at the moment we don't have that, but the market cap only deals with the circulating supply as opposed to the total supply, which may or may not be held elsewhere. It may or may not be not tradable. Okay, it may be held, as in the case with Ripple Labs, which is the corporate entity behind the token. Okay, so it's always worth knowing what you're calculating with in terms of market capitalization and the figures that you are using. Okay, so that's an example of when the market cap changes because of the tokenomics changing underneath that. Okay, and you can get bearish situations and you can get bullish situations depending on which way the tokens and the tokenomics are moving. Now, to finally finish with the most extreme differences in tokenomics, there is a token currently circulating called Shiba Inu, which is a meme token. Which, if you're looking at the YouTube channel, I have analysed in some detail. But there are effectively 1 quadrillion tokens, okay, with a circulating supply of half that. Okay, now this is the most ridiculous tokenomics out there. Okay, theoretically, it's not possible for Shiba Inu to even approach 1 cent. Because it will be worth more than the entire world economy at 1 cent. The market capitalization would be worth more than the entire world economy. So therefore, if anyone's holding out for 1 cent Shiba Inu, they are likely to be very disappointed or waiting an extremely long time for the entire global economy to actually catch up with this token. Okay, now the opposite extreme, there is a token called Yearn Finance, where there are only 36,666 tokens in existence. Notice the price discrepancy here, $31,000 versus $0.000712. Okay, there's probably not going to be a day in my lifetime at least where Shiba Inu touches 0.01 cents. However, for Yearn Finance to get to $100,000, all that needs to happen is $3 billion needs to come into the market. Okay, now that could happen very, very quickly from almost any other cryptocurrency project. The point is, 3 billion here, okay, could launch this over 100,000, and that would be a 3 times return. But in terms of attractiveness, if you were to introduce 3 billion into this particular market, okay, the price would double. You get 100%. Okay, so you get 3 billion and you get 3 times your return. Okay, through this, or you get 100% return through Shiba Inu. Okay, the point being that the more risk you take on, the greater your chances of opportunity, or the greater your profits, but obviously the greater your chance of loss. Okay, Shiba Inu doesn't particularly do anything at the moment that is earth-shattering and completely novel and new, whereas Yearn Finance has a token that has been around for a little while and has a very strong developmental project behind it, the Yearn Finance aggregator. Okay, once again, we're looking at fundamentals here, okay, but fundamentals go hand in hand with tokenomics, okay, and if you're looking to explore a token, any crypto token, looking at the tokenomics is really, really important for you to just gauge, 1, what is the opportunity here, and what is my risk, okay. I'll run through these again just for clarity, okay. So we have a market capitalization here of $3 billion for Shiba Inu. Okay, if you were to introduce another $3 billion into this, the price would double and you get 100%. Okay, from just that $3 billion. Okay, if the $3 billion were to come into this market cap here, okay, because the total market cap is $1 billion. Okay, you'd actually get 3 times your amount. Okay, so you actually have 3 times the return for an additional 3 billion. Okay, so you're not doubling the amount of market capitalization, you're tripling it, which means that this token will cross over the $100,000 mark and you get 3 times your return. Normally in these circumstances, the cheaper tokens outperform the larger tokens, but in this case, the tokenomics are so huge that that isn't the case with this particular token, okay? And you're better off buying Yearn Finance than you would be for buying Shiba Inu, even though the risks are completely opposite, okay? Yearn Finance has been around longer, has more support, has more tokens locked, okay? And generally is I would say, personally speaking, a higher quality project than Shiba Inu. But most people will run to the meme tokens because they think that they're going to get a better result from them, when in actual fact that's no longer going to be the case. Okay, so here you can see there that tokenomics is really important and really important to think about before investing in anything. You want to pick projects that have hard caps. You want to pick projects that have a low supply, ideally. You want to pick projects that have a distributed nature, many nodes, for example. You want to pick projects where you can tell when new coins are going to be generated, or at least there's some predictability about that, or when new tokens or old tokens are going to be burnt, which is the case for projects like BNB or Binance Chain. Binance Coin, for example, where there is a predictable burning of the token every few months or so. And you also want to make sure that you understand how the market capitalization is going to respond whatever happens to the tokenomics. So if there is a major burn event like CRO, underwent a 70% burn event, what is that likely to do to the price? Is that going to collapse the price because people are intimidated by that? Or is it actually going to mean that the total amount of market capitalization capital behind the token is going to get, moved from 70% of the market and compressed into 30% of the market, therefore pushing the price higher? The next video will deal with market capitalization, which goes hand in hand with these tokenomics, but understanding the mathematics behind each of these elements is crucial if you want to build and understand a portfolio and make the most out of the opportunities in cryptocurrency.